Hello there, my name's Jake Nielsen,
I'm Joseph Tao.
and over the course of this presentation, we're going to be showing you a financial analysis of two publicly traded companies, John Deere and Caterpillar. They both operate in similar industry segments and are very large in size, so we figured they'd be a good comparison.
First question is, who are our major shareholders? We found that a couple companies are very similar in both as major shareholders. BlackRock, Vanguard, State Street, and Fidelity are some of the names that came up. With the information we had, we believe that Deere was the more favorable company of the two because they are owned by a large percentage of mutual funds. Second question is, why do investors care about cost of capital? Cost of capital is extremely important to its investors for a company. By minimizing the cost of capital, the firm is able to increase the return on invested capital and maximize the cash flows to the firm. If a firm's cost of capital exceeds the return on invested capital, the firm is essentially destroying the value for shareholders. With the information we had, we believed that Caterpillar was the better of the two companies. They were both very close, but Caterpillar edged Deere out. For example, Caterpillar had a double the coverage ratio, which allows them to pay more interest.
And following up on that, now let's talk about what the cost of debt is for both companies. So we calculated cost of debt using a simple approach that takes the U.S. Treasury rate and adds a premium onto the U.S. Treasury rate based on the company's interest coverage ratio and its ability to pay back its debts. We plugged this formula into Professor DeModeron's calculation of risk premiums, and we arrived at a cost of debt for John Deere at 3.03%, as well as Caterpillar as well at 3.03%, because their current outstanding bond rating on their 30-year newest issue is the same rating, which assigns them the same spread on the U.S. Treasury yield. When we adjust for taxes, we see that John Deere's cost of debt is slightly lower at 1.88% versus Caterpillar's at 2.10%, and this is due to the fact that John Deere is in a higher tax bracket than Caterpillar, and they pay an average tax rate of 37% versus Caterpillar paying an average of 30%. Once we calculate our cost of debt, we then move on to our cost of equity financing, which brings us to our fourth question. We used a simple model for calculating cost of equity. We simply used some assumptions in the capital asset pricing model. Capital asset pricing model takes the risk-free rate and adds the multiplication times beta times the market risk premium in order to calculate a company's cost of equity. As we stated earlier, we use the 10-year Treasury bond yield for the current risk-free rate, and we cited Professor Pablo Fernandez's annual survey of market risk premiums in order to arrive at a risk premium of 5%. Again, this survey is a national survey that takes the market risk premium in several countries and is a survey that he conducts every year. We also assume that the market risk premium ranges between 5 and 5.5% historically, so the margin of error here is very small. In order to calculate beta, we ran a simple regression using both 2-year weekly returns as well as 5-year monthly returns. We then used an unlevering and relevering process in order to calculate these betas when they're adjusted for capital structure. We arrived at a cost of equity for Deere at 9.13% versus CAT at 7.99%, and this is mostly attributed to the fact that Deere takes on significantly more amounts of debt than CAT, and thus their equity becomes more risky. When we combine the cost of debt with the cost of equity, we arrive at a weighted average cost of capital, which brings us to our fifth question, is what is our weighted average cost of capital? The weighted average cost of capital for Deere is 4.59% versus CAT's at 4.75%. This is really easily explainable due to the fact that John Deere carries significantly more amounts of debt than Caterpillar and is in a higher tax bracket, which allows the tax deductibility of interest to be more in favor of Deere than CAT, and thus it brings their cost of capital down. We then move on to our next question is, can we lower our weighted average cost of capital by changing our capital structure? And we used Professor DeModeron's input model here in order to calculate the effects of changing capital structure. The current capital structure of John Deere by this model, which incorporates operating leases compared to our previous model, shows that Deere's current debt ratio is about 48.18%, and the optimal capital structure is actually at 50%, which results in about a 93% increase in value per share for shareholders. Caterpillar, when we plugged in their data into Professor DeModeron's model, we arrived at a current debt ratio of 47.59% versus an optimal debt ratio of about 70%, which will result in about a $2 increase in value per share to shareholders. Thus, we said that Caterpillar has the most upside here from changing their capital structure because they can create significantly more amounts of value by adding on more amounts of debt. However, as these companies add on more debt, brings us to our next question is, does this addition of debt create unnecessary risk for the companies? Of course, any addition of debt will increase the rate of bankruptcy costs and will affect the company's interest coverage ratio, which then makes the company essentially more risky. However, as we can see, it actually increases value per share to the shareholders. Thus, we feel that the addition of debt is actually a good thing for shareholders and in the long term will generate higher returns for investors. And we acknowledge that the companies are both cyclical in nature and go through upturns and downturns as well. So the company needs to really assess when they take on these additions of debt, whether it's good economic times or bad economic times, because that can also play into the shareholders' returns as the stock market price fluctuates in these cyclical times.
That brings us to question number 8. How would a financial restructuring affect the value of our company? Financial restructuring is sometimes a very effective tool that helps companies maximize their value. In the case of both Deere and CAT, both firms are under their optimal debt ratio, so by both companies going to their optimal debt ratio will increase the value of both firms. Question number 9 is, what does the competition do? Both Deere and CAT are the two biggest in their industry. Some of their other competitors, AGCO and Maniwak, are very much smaller at $4 billion compared to Caterpillar and Deere over $20 billion. What's interesting is both Deere and CAT have a higher percentage of cash and a higher percentage of leverage. Question number 10 is our stock price fairly valued? Both companies are fairly priced. They're slightly undervalued based on their current stock price and even if they were to raise to their optimal debt ratio.
All right. Well, we hope our presentation's given you a little bit more insight into these two companies and the way that they operate and the effects that debt will have on their optimal capital structure. Thank you for watching.